The rich never invest in these 7 things. How to invest money like the rich. Hello awesome people, this is Finance Boss and I'm back with this very informative and cautious video. First of all, I want to thank you for supporting me and I hope you're learning on this channel. Before we start, please click the subscribe button below and hit the notification bell so you will be the first to watch my next upload. Without further ado, let's get right into it. In life, one of the best ways to succeed is to take after the lead of those who have succeeded before you. And this method certainly works for investing. It's why thousands of people spend countless hours studying the investment strategies of people like Warren Buffett and Charlie Munger. The oldest say that investing is an intricate art, and knowing what investments to avoid is just as important as doing which you should invest in. Well, some commonly thought of investments can seem like winners when trying to grow your wealth. The reality is that some can actually cost you money in the long term, making them things you most definitely should avoid. So which investments in particular do billionaires avoid? Investment number 1, bonds. Well, it's true that a lot of millionaires do hold some bonds in their portfolios. This type of investment tends to be avoided when millionaires try to maximize their wealth. The first issue with bonds is that their returns are generally much lower than what you could realize by investing in stocks instead. In fact, many bonds barely keep up with inflation, earning on average just 3% annually. For example, in the past 3 years in the United States, the average inflation rate has been just over 2% annually, which means that on a $50,000 investment, you would be ahead 1% or dollars as a net return. So, if bonds have such low yields, why would anyone invest in them in the first place? The truth is that bonds are generally lower risk investments in stocks and are rather liquid, meaning that if you want to dispose of them, then you can get your money fairly quickly. Moreover, bonds tend to pay interest, making them income-generating assets. Unfortunately, their low yields make them more of a wealth preservation tool than a wealth generation tool, which is why millionaires tend to avoid putting large sums of money into this type of investment. Investment number 2, penny stocks. Any stock that trades on the stock exchange for less than $5 per share is considered a penny stock, and millionaires avoid them like the plague. Millionaires avoid this type of investment for a few important reasons. First, companies who trade low-value shares are not required to register with the Security and Exchange Commission, commonly referred to as SEC, and don't have to present their annual reports. In essence, this means that there is no oversight into the validity of the financial information these companies are reporting, making them very volatile investments. Moreover, having a lack of access to credible financial information makes it very challenging for investors to get a sense of the true value of their holdings, which is an important factor of millionaire investing decisions. Now, sure, these types of stocks do have the potential for exponential gains and significant returns for investors who want to gamble on these unproven companies, but millionaires know that penny stocks are bound to fall. Another reason penny stocks make for bad investments is due to their low levels of liquidity, because most people don't invest in these types of shares. Finding a buyer for a stock you own can be challenging. While most popular stocks are traded thousands of times a day, penny stocks are bought and sold less often, which also affects their price, which is another downside of penny stocks. Holding investments that are volatile in price makes it hard to gauge the true value of your holdings and can make investing very stressful as you see your money rise and dip to extreme levels over time. So for these reasons, millionaires don't invest in penny stocks. Investment number 3. Digital currencies. For the last few years, all anyone has talked about was Bitcoin and other popular cryptocurrencies. But this type of investment tends to be avoided by millionaires. Now, I would be lying if he said that there weren't people who made millions investing in cryptocurrencies, but these people are far and few between. The first problem with digital currencies is that they aren't government regulated. This means that there is no oversight into how the companies behind them are operating, which can be scary if you were investing large sums of money into them. The second problem with cryptocurrencies is that they have no inherent value. Their price is totally speculative, kind of like penny stocks, which makes the price spike when there is hype around them, and prices draw when attention cools off. Finally, unlike normal investments, digital currencies are at risk of hackers and theft. Take the example of Bitfinex, a Bitcoin exchange company. In 2016, the platform was hacked, resulting in depositors losing over $70 million. Sadly, this instance is not uncommon. It was highlighted in the US Department of Homeland Security study. Roughly one-third of all Bitcoin exchanges have been hacked at one point or another. So, if you add up all these elements and the fact that cryptocurrencies don't produce income like investment properties or dividend shares do, there's no wonder why millionaires seldom use digital currencies as a primary investment vehicle. Investment number 4. Certificates of deposit. Another unpopular investment of the rich are certificates of deposit. If you're unfamiliar with certificates of deposits or CDs for short, then let me explain what they are. A certificate of deposit is a product offered by banks and credit unions that offers an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. Essentially, you're trading access to your money for interest income. Unfortunately, CDs have the same main disadvantages: bonds. They don't offer very substantial returns, meaning that again you will struggle to fight inflation by investing in them. In fact, as of September 2019, the highest CDs only 2.25% annually. One upside to certificates of deposit is that it tends to have shorter terms and bonds, meaning that you can get a similar return while being without access to these funds for a shorter period of time, which equates to less risk. While CDs aren't a terrible investment, millionaires expect higher returns and rely on these returns to build their wealth faster. With 2 certificates of deposit aren't the investment of choice of the rich. Investment number 5. Collectibles. The next type of investment millionaires avoid are collectibles. Collectibles include things like art, antiques, stamps, classic cars, wine, and comic books. First, collectibles are only worth what someone else is willing to pay for them, meaning there is no real defined price for these assets. Commonly, cryptocurrencies, the asset's value is based on how much other people perceive it to be worth, rather than having a real monetary value associated with it. This means that nice painting you own may be worth a lot to you, but it's worth nothing unless you have a buyer willing to part with their money for it. And add to this issue, unlike stocks and bonds, there is usually little public information available for individual collectibles, making the valuation process that much harder. The second reason the rich don't use collectibles as investments is because they don't generate income. Sure, a painting is nice to look at, but it won't fill your pockets on a monthly basis, making it a less than ideal investment to hold. Probably the biggest downfall of collectibles as an investment is how it'll acquit. For instance, it takes the right kind of buyer to want to spend thousands of dollars on an antique car or comic book collection, meaning that if you want to part with your collectibles in order to recoup some cash, you may be waiting a while until those funds are received. You may be thinking, well, isn't it smart to have investments that will offset any losses that may experience? Well, in theory, this makes total sense. The reality is that precious metal prices don't typically go up enough to make up for the losses that you would experience in an economic downturn, making them quite lackluster as a hedging tool. The other issue with holding precious metals is that, like most of the other investments we've discussed in this video, they're rather liquid. Again, if you were in a financial bind and needed money selling off these assets, that may be harder than you would expect, leaving you without the cash you need. And if you need more of a push to avoid this type of investment, you should know that investing king Warren Buffett thinks that gold is a terrible investment. Buffett believes that stocks are a much better investment and often highlights just how much better returns on stocks have been in the past versus its precious metal counterpart. For instance, if you invested $10,000 in both gold and stocks in 1942, the value of your gold will now be worth $400,000. Now, this seems like great return, but at the same time, $10,000 invested in stocks would be worth a cool $51 million today, proving just how powerful stock investing can be. In fact, experienced investors like Warren Buffett won't invest in most stocks because they can be, and he's been investing for longer than most people have been alive. Buffett preaches the importance of investing only in companies you understand, and he practices this himself by restricting his investments to those that fall in his circle of competence. His circle of competence is where an investing expertise lies, and only businesses that fall into the circle are considered for investment. Buffett makes the argument that if you don't understand the business, how can you project performance? In a nutshell, if you want to begin investing like a millionaire, then you must stop putting your money into bonds, penny stocks, digital currencies, certificates of deposit, collectibles, precious metals, and lastly, companies you don't really understand. So, if you want to go from the life you have to the life you want, then hit the subscribe button. This is Finance Boss, and see you next time.